One of the reasons why the Senate could be delaying its plans for a cap and trade bill is concern over what might happen with the price of carbon once the trade side of cap and trade goes active under a new market. Yesterday, the Senate Energy and Natural Resources Committee had a hearing on exactly that, namely just how to fashion a trading platform and pricing for carbon without seeing runaway energy prices once that trading goes live. Clean Skies Dan Goldstein was at that hearing yesterday afternoon. He's in our newsroom now. So good morning, Dan. How exactly would the trade side of this cap and trade plan work, and how do senators, how do they want to keep a lid on these carbon prices?
Well, Susan, get used to hearing a term called price collar, and no, that's not a new discount grocery chain that I probably should shop at. But the idea is at the outset of the trading range, when this goes live, is to set a range, as it were, for carbon allowances with a ceiling and a floor. And the price cap is designed basically to prevent runaway costs and runaway trading, what we had in California back in 2000 and 2001. The way they look at it is obviously a cap would keep some of the costs under control, but also a floor would help keep the money flowing just in case there isn't demand or the costs basically are lower than the expected. Now, in the Waxman-Markey bill itself, there are these ceilings and floors, $10 for the floor in year one, $28 for the ceiling. But here's the thing, is the EPA says in 2015, that's probably going to be around price of carbon is probably going to be around $13 to $15 a ton. So you can imagine the scenario basically where if you've got a $28 cap, you can imagine what might happen. This is what they're worried about. You remember when Henry Blodgett in 1999 made his famous call, a $300 price target for a little internet stock known as Yahoo, and we all know what happened to the internet market then. It basically took off in Zoom, since basically that's what they thought the target was. And that's why experts think this collar might work.
And so the benefit of a cost cap is it essentially allows people to agree to disagree. If the prices are low, as many would hope, then the presence of a cost cap is of no accord. And if prices, in fact, are much higher than people predicted, well, then you want a cost cap because you don't want to have the potential damage to the economy. In broad strokes, I think the combination of a cap and a price cap or collar really provides the best elements of both a tax proposal and a cap and trade program. And that's why we think it really is the obvious way forward.
Now, members yesterday, the Senate Energy and Natural Resource Committee, they were worried about what might happen if they do indeed create that new market, and they don't want to happen nationwide. What happened in California, obviously in 2000 and 2001, when California deregulated its power market. So what they're looking to do is say, let's try this cost collar, see if it works, and if the government, and if it's not working, the government needs to step in with more regulation, and that's one of the things that they think could work.
We share the very broad desire that there be aggressive oversight of this market, and understand the visceral anxiety many of you must have at this moment in our nation's history of creating a new market that may have $100 to $200 billion of value. An important benefit of a price collar is that combined with the reforms that are generally being proposed by the administration for all commodities, you can dramatically reduce the price volatility, and in doing so dramatically reduce the potential for market manipulation and the potential for undue profits.
One of the ways they think they can limit that, just in case it does hit the $28 cap, is simply do this, is to simply sell more of those carbon allowances too. But the one thing they are concerned about is in Waxman-Markey. They say the Waxman-Markey, at least some of the senators and some of the experts yesterday that were testifying, they say the Waxman-Markey bill is still too dependent on offsets, and they would rather see more of an auction scheme, something closer to what Obama actually originally wanted in his plan. Susan?
The big worry, Dan, what about speculative traders in this new market? How do they decide between non-commercial and commercial buyers?
Yeah, and that's actually going to be one of the things that they're also going to look like, and that may be also a reason why, as you heard, Majority Leader Harry Reid wants a little bit more time on this, because one of the problems is when this trading goes live, if you think about it, who's going to get what? You've got commercial traders who obviously are going to need to buy and sell these allowances for their own needs, but obviously no trading system can exist without the need for liquidity, and probably, as we all know, is in the oil markets, you need some of those speculative buyers, the non-commercial traders, as it were, to step in and be the other half of that trade, just in case you need to buy or sell something. You can't have it without those non-commercial traders. So the real question is, how do you set the balance? Who's going to have limits, and where is it going to go? And obviously, we saw what happened in the oil markets, where you had non-commercial traders stepping in and buying oil, and the concern obviously is, again, they don't want a runaway carbon market. Susan.
Right. Okay. Clean Skies Dan Goldstein, thank you.